All right, hey everybody, welcome to chapter 10. All right, you should have gotten done with the accounting fundamentals, and I'm hoping that you understand that. If you have any questions about accounting fundamentals and the things you should have learned in Accounting 111, I highly recommend you get with me so we can catch you up. The reason for that is because it's absolutely crucial to know the accounting fundamentals before you begin this course. This course is going to be building upon those fundamentals, and it's important that you know them, okay? So this chapter is plant assets and natural resources and intangible assets. All right. These are the assets that we're going to be dealing with that have a longer useful life than 1 year. Okay. It's longer than a year that these things are going to be used. And so we're going to have to really apply the expense recognition or matching principle when we're dealing with these assets. And that's why we're going to take and treat these differently than we would our current assets or our short-term assets. So we're going to go ahead and evaluate these and how to do that in this chapter. Let me get back over here. Oh, no, that screen needs to go away. All right, here are your learning concepts and everything. You can click on that if you would like. I'd like that little bar to go away. There it goes. You can pause here and look at this. We will be doing the total asset turnover. Let's look at this. Okay, so plant assets. We're going to start off talking about plant assets. And first of all, plant assets, in generally speaking, are going to be something tangible. We're going to have them. It's going to be something we can physically touch. We can experience, see. I guess you could taste it if you wanted to lick them or something. Now, I'm looking around for an asset. Some asset that you might be aware of is your phone. Hopefully, this is a long-term asset. Okay, here's my phone. This phone lasts me longer than one accounting period, okay? More than 1 year, I hope, all right? At least more than 1 month and even more than 1 quarter. And so this cost, because I'm going to have future benefits over several accounting periods, using the accrual accounting method, I can't just expense this all in 1 year in theory. There's, capitalization policies and things like that that are more advanced concepts we're not going to talk about. So we're going to assume anything that is over a year is a long-term asset that needs to be expensed over that period. So this is what we call property, plant, and equipment. So this would be property, that phone that I just showed you. Now, the deal with these plant assets, we expect to use them longer than 1 year. So as we use them, they begin to wear out. Now, I can't demonstrate this for you in this course because I can't bring a phone and just sit here and we just stare at it watching it for it to depreciate, okay? The use, the level of abuse it takes and things like that, it's going to take a while for it to depreciate. Now, I want to also emphasize that the methods of depreciation we do for accounting does not necessarily reflect the current or future value that vehicle or that asset, whatever it is, the vehicle's on the board here. That's why I said vehicle, but it doesn't necessarily reflect the actual value that car or that equipment could be at. All right, if you take good care of a vehicle, for example, and you don't abuse it, it's not a car rental, things like that, the value of it could be very well higher than what the book value is going to be when you go to sell it. All right, so just keep that in mind. So first, we need to compute the cost of any of our plant assets. We're going to have to look at the purchase price. We're going to have to look at any and all expenses that could bring it into a usable working condition. So one of those things could be that when, let's say we're buying a vehicle, okay? First, we're going to have vehicle licensing tax to initially get that to be able to drive it. Yep, we're going to need to include that in the cost. Sales tax, you bet we're going to be paying sales tax unless you live in Oregon or some places that don't do I think it's Oregon doesn't do sales tax. Oregon and a couple other places. But anyway, you're going to need to have, if there's any transportation or storage or anything else to get that equipment, vehicle, or whatever it is to your place, even if it's like an equipment and you have to do test runs on it to make sure it works right, all of those are expenses that you will capitalize in the cost of acquisition for that asset. So let's look at machinery and equipment. Here are some examples of some things that you would include: transportation charges, insurance, installation, purchase price, and taxes. Okay, and those taxes aren't just sales tax. If you're buying it from another country, there may be tariffs, import duties, things like that you have to pay. Buildings, you're going to have brokerage fees, attorney's fees, title, taxes, cost of the actual purchase. Maybe you're going to need to do a valuation on that. All kinds of expenses that I learned when buying a piece of land or building. Land improvements, okay? Land improvements are a little different, okay? First of all, that's not land. Land is not depreciated. Land improvements are. So if you just buy a lot of dirt and that's all you have, you're never going to depreciate it. You're going to test it for impairment. Don't worry about that right now. Land improvements, you put a parking lot on it. Well, parking lots last for a certain while, and at some point they start breaking and they need to be repaired. And at some point, you're going to probably need to redo the whole thing. So we're going to go ahead and we're going to depreciate those. Driveways, fences, walkways, lighting systems, all these things are going to take maintenance. That's going to be what's expensed during the years. But for actual installation, you're going to depreciate it over the expected life of those assets, okay? And then here's land. Again, land is not depreciated. You have your purchase price, your real estate, legal fees, surveying fees, basically anything that it would take to actually get you that piece of land. But it's not depreciable because land doesn't depreciate unless something bad happens to it, like you have a nuclear spill, toxic waste spill, nuclear radioactive substance that infects it. And so what you do is you test it if something like that were to happen for impairment, and then you write it all off at that point if that's the case. But otherwise, it's understood or expected that land is never going to go bad. That's why we don't depreciate land. So what if we buy, like we do when you buy a house, you buy the land underneath the house and you buy the house itself. So what do you do when you purchase this situation? So what we're going to do is, in this case, it says CarMax paid $90,000 cash to acquire a group of items consisting of land appraised at $40,000 and a building appraised at $60,000. So what we're going to do, if we paid less than its fair market value under this appraisal situation, or if we paid more than the fair market value of the appraisal, what we're going to do is we're going to allocate the cost towards what the actual value is. So in the case, the appraised values total $100,000. We see that. I'm going to use the mouse. Hopefully you can see this. We have a $60,000 appraised value and a $40,000 appraised value for building and land respectively for a total of $100,000. What we're going to do is we're going to get the percentage of that appraised total, and 60% goes to the building and 40% goes to land. So we're going to take that $90,000 we paid and multiply by 60%. That's going to go to our building and 40% to our land. Total amount will be $90,000 because we've got to value this at our cost. We can't record it at its appraised value or its fair market value. So we paid $90,000, so we're going to reflect that our assets total the amount of cash we paid for it, which was $90,000. So we're going to debit our building for $54,000, debit the land for $36,000, credit cash. That's what we paid. Or it could be note payable, or it could be some other liability, or some mix of a cash and liability payment. Okay, a lot of times that's what happens. Is it's actually going to be a cash and a note. You know, that's why when you say that you go buy a house, it's like $20,000 down, the rest is financed. All right, so in this situation, we're going to record these depreciation expenses using the straight line, the units of production, and the declining balance methods, okay? First of all, I just want to point out I can't stand, I can't stand the double declining balance or the declining balance methods. I just hate it, okay? But you will need to know it, and so I will teach it. But the bottom line is once we have our acquisition costs, the idea is that we need to show what we use each counting period in those accounting periods. We can't just expense the entire amount in one accounting period because we expect to use it for more than just one. So we need to allocate that cost. And the way we do it is we calculate our depreciation. Our depreciation is going to be its cost minus its salvage value. Excuse me, I'm just telling you the straight line depreciation method. We need three things: cost, salvage value, useful life. When we do the units of production, though, we're going to need the units of production method. Okay, so we need the units of production of the amount we think we're going to produce. So we do need a fourth one, but that's only for the units of production method. So here are our methods. Let's go ahead and show you what we have here. We see our cost is $10,000. Our salvage value is $1,000. So we're only going to be able to depreciate $9,000 of this cost. We expect this to last for 5 years, and we expect that we're going to make 36,000 shoes for this piece of equipment that we purchased. So our straight line method is very simple. We have the cost minus the salvage value divided by its useful life in periods. That equals a 10,000 minus 1,000 over 5 years equals $1,800 per year. So it does not matter how many, what year you do this in, you will always depreciate $1,800 of depreciation expense using the straight line method. Now, your depreciation expense, $1,800 to debit, you're going to credit to accumulated depreciation for machinery. This should be somewhat familiar to you. We did this a little, we talked about this in Accounting 111, but now we're showing you how we calculate it, okay? Accumulated depreciation is our contra asset account that goes against the machinery, in this situation, the machinery asset, and we're going to show this on the balance sheet as we're going to show the total cost of the machinery, which is $10,000, and we're going to subtract or show that it's less than its accumulated depreciation. And that's going to be the $1,800, which is going to leave us a book value of $8,200. You see here the depreciation expense in that graph. It doesn't change from year to year, but we show that the book balance declines all the way down to the $1,000. That's the salvage value of the asset over the life of the asset. That's what it is intended to do. And once at the end of that life of the asset, we're going to dispose of that asset in whichever way we can for that amount, ideally. Here's our schedule for straight line depreciation method. Okay, our depreciable cost stays at $9,000. Our rate stays at 20%. Our expense stays at $1,800 the entire time. Our accumulated depreciation increases by $1,800 each year until it gets to that $9,000, thus reducing our book value to $1,000 at the end of the life. That's our salvage value. This is how it should work out. If at the end of your calculations you did not get the salvage value as the book value, then you did something wrong. All right, units of production method, it takes 2 steps. Okay, first of all, we're going to need to take our cost minus salvage value divided by the total units of production. And what that's going to do is going to give us a depreciation per unit. Then we're going to take our depreciation per unit, multiply it by the number of units we produced in the accounting period, and for that accounting period is going to be the depreciation expense. So let's look at it from this standpoint, okay? Let's assume 7,000 units were inspected and produced basically during the first year. Depreciation would be calculated as follows. So first of all, we take our $9,000, which is our cost minus salvage value. We divide that by 36,000. That gives us a 25 cents per unit. We're going to take that 25 cents, multiply it by 7,000, and we get $1,750 in depreciation expense for year one. Okay, in year one, it's $1,750, but in the following years, it's going to be additional, or it's going to be different costs. It happens that in 2024, we had the same one, but either way, we get down to the last year, okay? Let's look at this, see if I can pop open my calculator over here, okay? We produced, let's see if this adds up, 7 plus 8 plus 9 plus 7 plus 5. Okay, look, we produced 36,000 units, and that's exactly what we did. But what if we produced, in that last year, what if we produced 6,000 units? We had 6,000 units multiplied by 0.25, that would have been 1,500. But if we added that to our depreciation expense in prior years, we would have over depreciated this by $250. Can't do that. So even if on year 2025 we produced anything over 5,000 units, we would still only depreciate $1,250 to get it down to our salvage value of $1,000. You cannot depreciate beyond the salvage value. And then there's the declining balance methods. This one's a 3-step. First, we calculate the straight line rate. We take 100% divided by the useful life. In this case, it was 5 years. Gets us 20%. Then we take the double declining balance rate of 20, or we calculate that. We take 2 times the 20%, which is 40%. And then basically we take the beginning period book value and multiply it by 40%, or that double declining balance method. So here we see that in year one, we have $10,000 multiplied by 40%. Notice we do not take out the salvage value. And then our first year, we're going to take $4,000 of depreciation expense. In year two, we're going to take $6,000 because that's 10,000 minus 4, and get $2,400. And you see we depreciate down until we get to that $9,000. And again, with this situation, there are some situations here where you could over depreciate. So you got to make sure in that last year you don't go beyond that 9,000 or whatever the total amount of depreciable amount of the asset is. Comparing the depreciation methods, you can clearly see that the straight line method is preferred. Why? Because look at this. Look at all three of the methods. Regardless of which method you use, you are going to see that you depreciate the assets by the same amount over the life of those assets. Now, why in the world, if this is the case, would you take a complicated depreciation method over a simplified one? Being simple with it, yes, maybe you don't take advantage of certain tax benefits in the early years, but you're going to not have the tax benefits in later years. Those are for your management to decide, or you, if you're a manager, to decide as to which one you're going to do. But bottom line is, since you get to the same number, the straight line method is preferred by most companies. There are other units or other types of depreciation methods, but most of them use straight line. There is a makers for depreciation for tax. I am familiar with this, but it's not accepted for financial accounting. What happens when you buy an asset? So like a lot of the times we buy our assets in our accounting classes in the past, we've said on January 1st, we bought something. Okay, nobody's out there on New Year's Day buying these assets. I'm certainly not. So we're talking now, hey, what's reality here? What is really going to happen? In October 1st, 2020, we go out and buy some big piece of asset, $10,000, salvage value, it's the same thing we just bought, okay? We still calculate if we're using the straight line method, we still calculate whatever depreciation expense we were going to calculate for the year, whether it's the straight line, accelerated, or units are productive. Doesn't matter. You just still calculate that same balance. Then you just multiply by the number of months of that year and divide it by the 12 of the months, total of months in the year. So in this case, we have October, November, December, 3 months, 3 divided by 12. Multiply that result by the depreciation expense we calculated that should have been for a full year, and we get $450. Just that simple. Just take it by the ratio or the fraction of the months over the total number of months in a year, which is always going to be 12. And that's what you'll do. So it doesn't matter if it's October or November or April or February. You can do this math. It's just straight. Just change that numerator there on the yearly amount. So what happens when what we predict is not accurate? Remember, as accountants, we don't like predicting things. We don't like guessing. We want to know what it really is. But when we're dealing with an asset, we don't know how long it's going to last. For all we know, it could burn up in a fire in year 3. It could break down in year 5, and it could last 18 years instead of 5. We don't know. Okay, things could happen. We could have some kind of increase in technology or something that's going to make it to where that piece of equipment is more useful because they've come up with some kind of silicone spray that prevents wear and tear. Who knows? We don't know. So we're predicting things. One thing we're predicting is its useful life, and we're predicting its salvage value, and using those estimates to create a depreciation expense. What happens when we have to change? First of all, we didn't make a mistake, so there's no error. It's not an error when we change our estimates, okay? So what we're going to do, let's look at our machinery here. We determined that the remaining useful life is 4 years. So let's look at our machinery from previous examples and assume that the beginning of the asset's 3rd year, its book value is $6,400. At that time, it is determined that the machinery will have a remaining useful life of 4 years, which means we're going to have this thing longer than we thought, okay? We thought it was going to be only 5 years, but after 3 years, we realized we have 4 more years. That's a total of 7 years. And the estimated salvage value will be revised downward from $1,000 to $400. What we do is we take our current book value, $6,400, okay? We subtract out our revised salvage value of $400 and divide it by whatever's left at this point. Don't divide it by 7. We're dividing it by 4. And we're just changing our estimate, and we're only impacting the current periods and the going forward. We're not going to restate anything we did in the past. We're not going to recalculate this $10,000 starting there because we've already depreciated $3,600 of it. So we can't change anything we've done in the past. We're only going to adjust it going forward. Now, what is this going to do to the income statement? Okay, well, that's a good question because let me go back really quick. Our straight line method, was $1,800 every year. So all of a sudden, we now have a reduction in our depreciation expense by $300. Our net income's going up by $300. Our CEO might want to know that. Why our net income is going up for $300 all of a sudden for doing nothing. Our CEO might also want to know if this was more than what our depreciation expense was in the prior years, because now all of a sudden there's less net income, and that's something that they will definitely want to know, okay? All right. Revenue and capital expenditures and how to account for them. So when you have a piece of equipment or some kind of property, plant, and equipment, you might make repairs on it, or you might do some kind of maintenance on it. What do you expense and what do you capitalize? Capitalizing is basically adding it to the value of the asset and recomputing your depreciation on it. Revenue, they call them revenue expenditures, but basically it's an expense. It's basically maintenance, annual maintenance, things that aren't going to increase the capacity or the useful life or anything else. We're just going to expense them right away. But capital expenditures, it's going to improve the equipment. It's going to increase its useful life. It's going to help it produce more things or whatever. We are going to add that to the assets account, and we'll go forward with that. So here we go. Ordinary repairs, maintenance, oil the machine, clean it up, do those things. That's not going to really increase anything. It's just going to keep it to its normal useful life. But betterments and extraordinary repairs. What if we need to replace the transmission on our machine? Okay, well, that's going to increase the useful life, right? By replacing that transmission, maybe that piece of equipment will last 4 more years. Okay, so we're going to have to consider that. And maybe it'll make more things for us. So those are the things that we're going to capitalize. Ordinary repairs, here's your journal entry. Betterments or improvements, you're going to just add it to the machinery amount and recalculate your depreciation. All right, now at the every piece of asset at some point is going to have its day where it ends its useful life, and we're no longer going to do it. First thing we do is we update the depreciation at the date of the disposal. We're going to journalize it, and we're going to remove it. So let's see how we do that. If we're getting any consideration, which means if somebody is giving us money, plant, property, any other asset, we need to find out if we're going to have a gain on it or a loss on it, or if everything balances out, we're good. And that's what we're looking at. So this if cash or consideration is greater than book value, we're going to have a gain. If the consideration is less, it's going to be a loss. If it's equal, then there's no gain. So let's look at this. We have an asset here. We fully depreciated it. It's $9,000. We're discarding it on June 5th of the current year. Okay. If we're just getting rid of it, we're literally hauling it to the dump and we're just getting rid of it. We're going to take it off of our books this way. This is our machine costing $9,000. This is not a carryover from the last one where the $1,000 was salvaged and it was $10,000. This is not a carryover. It's just, we cost us $9,000. We're just trashing it, putting it into the dump or whatever. We're just going to get rid of the accumulated depreciation and get rid of the machinery by debiting accumulated depreciation, crediting the machinery. It's gone off our books. We're done. So what happens if the equipment was costing $8,000 and accumulated depreciation was $6,000? So the previous year, we discarded it in July of the current year, okay? So we got a couple things happening here. We use the straight line method. So we need to record our depreciation expense because we did not fully depreciate this, all right? So our depreciation expense for the year is going to be that $500 on July 1st because that's 6 months, all right? Don't make the same mistake I did on the CPA exam when I thought June 1st was 6 months. It's July 1st is 6 months. I thought it said June 1st, so I did a depreciation calculation for 6 months. It should have been for 5. Long story. If you want to hear about it, let me know. Anyway, we're going to record our depreciation expense of $500. And it says 0 salvage value, so that's why we're going down to where it was at. So if we're just discarding it, it says it was discarded on July 1st. We're going to have a loss on this disposal because we only depreciated $6,000 prior. Add in $500, that's $6,500 of accumulated depreciation. Loss on disposal, we're getting rid of it. $1,500 is our debit. It's a loss. And then credit the equipment for $8,000. Bottom line, the best way to calculate this and the way I like doing this is I first debit the accumulated depreciation, put that number in there, credit the equipment, $8,000. And if we got any assets, debit that asset. And then whatever's left over to balance this, if it's a debit, it's a loss. If it's a credit, it's a gain. Okay. You might want to just pause it right here, rewind it the last 10 seconds, and hear that again a few times to kind of really, focus and think about that. All right. That's fine. But that's the way it is if you want to do it the easy way, but or the non-thinking way, I guess I should say. But just being able to look and see if you got anything out of it, then in this case we didn't get anything out of it. So did we dispose of it? Basically, it's a loss because it wasn't, our book value was 1,500 and we weren't getting anything out of it. So when we disposed of it. Okay, what if we're selling it? All right, if we're selling it again. We're taking that $1,000. This one, let's see. Sales equipment that originally cost $16,000 has accumulated depreciation of $12,000 at December 31st. This is 3 months later, January, February, March, all 3 months. Okay, so we're using the straight line depreciation. It's $4,000 per year. So what that tells us, and without seeing that there's no salvage value, this had a useful life of 4 years. 4, 8, 12, 16. That's how I know. Okay. 16,000 divided by 4 would be 4 years. So we sold the equipment for $3,000 cash. We're going to record in March our depreciation expense. We're going to take $4,000 and we're going to multiply that by 3 months and divide it by 12. That gives us $1,000. So we're going to increase our accumulated depreciation from $12,000 to $13,000. So we're going to put accumulated depreciation of $13,000. Cash is what we're receiving in $3,000. $3,000. That equals $16,000. That's our cost of the equipment. So we are going to credit our equipment for $16,000. There is neither a loss or a gain on this situation. Now, what if we sold it for more than that? We had $7,000 cash we got. Okay, let's look at this. It is the same exact journal entries as before. Okay, but now that we're getting more, we're going to increase our cash by that $4,000. It was $3,000 before. Now it's $4,000. Well, guess what? Whatever it is above book value is going to be our gain if it's above. So $4,000 is our gain on the disposal of the equipment. Conversely, if we sell it for less, we're going to take it as a loss. In this case, we sold it for $500 less than our book value, so we're going to take a $500 loss on the sale of that equipment. Okay, natural resources and asset depletion. Okay. Basically, this is very similar to the units of production method. You estimate how much. Well, let's talk first about what you're gonna deplete. You're gonna do all of the costs that you take to buy the mine or whatever it is, and then you add anything else you're going to need to repair the land and make it back to its normal condition. Okay. So you take that total amount, then you estimate how much you're going to extract from this. And then you take that and you basically do the same thing you did for the units of production method. So here we have cost of $500,000. There is no salvage value. So we have a total capacity we estimate is 250,000 tons of material. So we have a $2 per ton depletion rate. So in year one, when we extract 85,000 tons, we multiply that by 2, and our depletion expense is going to be $170,000 in that first year. Again, this is exactly like the units of production method, except it's depletion. You're depleting the natural land or whatever of its natural resources. It could be gold, it could be silver, it could be oil, it could be whatever it is. Yeah, if you don't sell it all, then you're going to have inventory. You're still going to, show that you have the expense of the accumulated depletion. You're just going to show that you haven't expensed it yet because you haven't sold it. That's all they're trying to show you here. This assumes that you sold it. and that's with everything else. As you depreciate things, you have to factor in also as whether or not you've sold it. Okay, this is extracting, same concept. Don't worry about that so much. Just know the depletion amount. Accounting for intangible assets. Tangible assets are a little bit of a different ballpark. They're non-physical, right? You think of stuff like Microsoft, okay? Does Microsoft have an intangible asset? Of course they do. When you hear the word Microsoft, it gives a sense of, oh, that's word of mouth. We know that that's a computer company. They have copyrights and patents to their Windows program, as well as their Office programs and things like that. So all of these intangible assets, those softwares and stuff like that are different ballpark. But what we're talking about here is copyrights, license, patents, leaseholds, things like that. And so, oh, and here's a list of them. Good. Right of use asset or a lease, leasehold improvements, other intangibles, research and development, water rights, they're another intangible asset. Basically, everything is cost plus purchase price, legal fees, filing fees, anything that it takes to keep it. Even if you defend, if someone's trying to infringe on your copyright, patent, or anything else, you can sue, and you can, and if it's successful, you can put those litigatory things into your intangible. Sorry. Software, non-compete covenants, customer lists. These things are they're dealt with in a little bit different ways, but they're there. Just want to make you aware of what these are. We're not going to really go over how to test them for impairment or anything else like that. Just know that they're there. Total asset turnover. All right. So how does a company use its assets? This is a good way to figure it out. You take total net sales, mind you, not gross sales, net sales, and you're going to divide it by the total average assets. Add beginning year assets to the ending year assets divided by 2. That's your average total assets. Net sales divided by that, that's your total asset turnover. You're looking for a higher number. You want to see that that number is a better number each year if you can, or at least somewhat consistent. Looking here at Starbucks versus Jack in the Box, it looks like Jack in the Box has improved over the years and Starbucks has declined, okay? These types of things you look at and you want to find out why this is going on, okay? How is the company using its assets? Maybe Starbucks assets are becoming older and they're not being used as efficiently, whereas Jack in the Box maybe in a year or two ago improved its assets and bought new ones, and so they're more efficient. You know, things to look at. Those are kind of what you want to look at. We're not going to go through exchanges, so don't worry about this. I'm just going to skip through this. You'll have the access to these. That is the end of the chapter. You guys make sure you do your homework, get all this stuff done. If you have any questions, contact me or your professor. And I wish you good luck, and we will see you in the next chapter.